Namaste, welcome to Arthaniti. Today I'm going to make a small video, a tutorial about what are equity shares and what are preference shares. Well, some things are Bapre, this is difficult, but still, okay. Getting back to the topic, what are equity shares and preference shares? Now, people have started investing in stock markets, and there is newfound love about the kind of returns that the stock markets are giving. Yes, this especially happened during COVID, and people have started noticing that stock market is the place which will help you get returns which will beat inflation. But there are certain basics which if not clear, yes, can cause a lot of confusion in your investing decisions. Well, this is a video to sort out that simple differentiation about equity and preference shares. First of all, when one applies to an IPO. Yeah, recently Sula Vineyards came out with the IPO which got subscribed more than 2 times, correct? Do you know what kind of shares you will be allotted if that happen? If you have invested in that IPO, will it be equity shares or preference shares? Well, if you don't know the difference, please listen to this video carefully. Right now, when you apply to an IPO, you are allotted equity shares of the company. Equity is what? Shares which are divided into equal face values. They are capital which is offloaded by the company so that people can buy that capital and become co-owners in the business. Correct? So when you become an equity shareholder, you become a co-owner in the business. Correct? So along with ownership comes risk. That is why equity shares are a high risk category of investment. Right? Now, when you become co-owners in the business, there has to be a liability which comes along with the reward, the returns, the dividends, or the capital appreciation that you get if the share price of the company increases or the profitability of the company increases and you get rewarded handsomely by way of dividend. So what is the kind of liability that an equity shareholder has? First, when a company issues equity shares, it becomes a limited company. The name itself says that the liability of a limited company is limited to the amount that the person has invested in the company. So the amount that you have invested to buy equity shares, that will be the only liability, that will be the extent up to which your liability will be limited. Tomorrow, if the company has to be liquidated, what happens is your money that you have invested in the equity shares, you will not get it back, and that money will be utilized to pay off the debts. Correct? So that is the liability involved when you purchase or when you invest in equity shares. What happens about preference shares then? Well, preference shareholders are not owners of a company like equity shareholders, right? But they are not creditors as well. The company doesn't hold when you have invested in debentures. I'm sorry, the company, it is the responsibility of the company to pay back the money that the debenture holders have invested in the company, but there is no such responsibility in case of preference shareholders. So then what is the difference between equity and preference shares? Well, preference shareholders get preferential treatment. Correct? Preferential treatment where when distribution of profit takes place, preference shareholders are given preference over equity shareholders. So before equity shareholders get their share of the pie, their share of the profit, preference shareholders are first given their share from the profit by way of a fixed rate of preference shares that is announced at the time of the public offer that is made for preference shares. Correct? So where dividend on equity shares is fluctuating. Why? Because it depends on the performance of the company. If the profit of the company grows at a healthy pace, the dividend rate will also grow likewise. correct? But in some years, if the company faces losses, or if the company has to undertake heavy capital expenditure, and the company decides that it is not worthwhile to give dividends to the equity shareholders, then equity shareholders have no say. Yeah, they do not get dividends in that particular year, correct? But what happens to preference shareholders? Well, preference shares have specific fixed rate of return, and they get their dividends with that specified rate every year, correct? Now again, there are conditions which I'll come to a bit later, right? Then what happens to preference shareholders and equity shareholders in the decision making of the company? Now, initially I told you that equity shareholders become co-owners. Now, being owners, taking up a liability may be limited up to the amount that the investor shareholder has invested, but still there is a liability involved, there is a considerable amount of risk involved. So for that, the shareholder is rewarded rewarded in the way that he can be part of the decision making process of the management. He has voting rights. The shareholder has voting rights, so he is very much a part of the decision making process of the management of the company. But no such voting rights are available with the preference shares, so they have no say in the decision making process of the company, right? So with risk comes the reward, and the reward is equity shareholders can have their say in the way the company is functioning, correct? Now, redemption. What about redemption? See, these are not fixed deposits. These are not debentures. So, there is no fixed maturity when it comes to equity shares. If you purchase equity shares, redemption will happen only in case of winding up of the company. And that too, equity shareholders are the ones who are redeemed the last, after paying the creditors, after paying what do I say, all the debts, debenture holders, preference shareholders. If any money still exists with the company, then equity shareholders are redeemed, correct? So redemption is only at the time of winding up of the company, correct? But there is a way out, right? If the equity shareholder is not happy with the performance of the company, or if the equity shareholder wants to sell off the investments that the shareholder holds in the company, then what is the way out? Well, the way out is going to the secondary market, the BSE and NSE, and selling your shares in the secondary capital market, right? What happens about redemption in case of preference shareholders? Now, there are two kinds of preference shares. There are many kinds, but I'll explain these two first. There are redeemable preference shares and there are irredeemable preference shares. Well, in India, by law, it is prohibited to issue irredeemable preference shares. Why? Because then it will become as similar to equity shares, but only with a fixed rate of dividend. So, irredeemable preference shares are prohibited by law to be issued in India. So, what are redeemable preference shares then? The law says that any company which is issuing preference shares cannot have the preference shares for a maturity more than 20 years. So, preference shares will have to be redeemed back within 20 years from the date of issue, right? Now, what happens? There is an issue of convertibility. Most of the companies, what do they do is, since this is the clause that preference shares have to be redeemed within 20 years, most of the companies issue convertible preference shares. This is a third type of preference shares. First, I told you about redeemable and non-redeemable preference shares. The second one, the second part is convertible and non-convertible preference shares. What are convertible preference shares? Say after a specific period of time has elapsed, say 10 years, 12 years, 15 years, depending on the company, the preference shares are automatically converted into ordinary equity shares. So once that time has lapsed, the preference shareholders become equity shareholders. So there is no question of redemption in that case. companies can issue, most of the companies do issue convertible preference shares. Why? Because to bring down their liability which may occur after the lapse of that particular time period. Correct? So I told you about two kinds of preference shares: redeemable, irredeemable, convertible, non-convertible preference shares. Correct? Now, return on equity is by way of dividend. Return on preference shares is by way of fixed rate of dividend. But there is a third type of preference shares which are called participating preference shares. In the sense, what are participating preference shares? Well, these shares give a added advantage to the preference shareholders, whereby first they get the fixed rate of dividend at which their shares have been issued, plus if the shares are participating preference shares, the preference shareholders get to participate in the additional share of profit. So along with the fixed rate of dividend, they can earn additional returns by way of percentage of the extra profit that the company makes. So this is an added advantage of participative preference shares. Right. Now, what happens if say in a particular year the company has suffered losses? Many such companies did during COVID, right? And if there is a loss, do you think companies can give returns to their equity shareholders? Well, no. When the company faces losses, or the company has decided that instead of distributing the profit by way of dividends, it wants to reinvest the profit in its own company for expansion needs, yeah, or starting a new branch, or starting a sister concern, buying another company. There are so many things that happen in corporate world, correct? So if that is the case, if that is the decision that is made, then dividends are not distributed in the equity to the equity shareholders, and they have no say. That is the risk that they are ready to take when they take up ownership of the equity shares. In preference shareholders cases, what happens is, again, these are the fourth kind of preference shares. These preference shares are called cumulative and non-cumulative preference shares. Now, what are cumulative preference shares? Say in a year the company faces losses and the company is not able to distribute dividends. In that case, in case of cumulative preference shares, what happens is the dividends that were supposed to be paid are carried forward to the next year. Correct? It is carried forward to a future year till the time the company makes profit, and all the arrears that were due to be paid are paid in the year in future when the company makes the profit. So cumulative and non-cumulative is what? If the company, it is same like how equity shareholders have no say. In case of non-cumulative preference shares, what happens is, if the company is unable to pay dividend, the preference shareholders will have to let go of the dividend for that particular year, in case the preference shares are non-cumulative preference shares. Now, what kind of investors should invest in these two shares? First, let us look at equity shares. Obviously, as I told you, being co-owners, there is a considerable amount of risk of losing the capital that you have put into the business in case the business becomes insolvent. Correct? So that is that risk involved. So people with high risk appetite should think of equity shares. In case of preference shares, what happens is, people with low to medium risk appetite can look at this option for investing depending on the other financial aspects of the company, right? So why am I saying low to medium risk? First, there is no volatility of returns. Returns are fixed if the company is making profits. Again, if they are redeemable, as per law, no company can issue preference shares which have a maturity of more than 20 years, right? So these shares are redeemable. So you have a surety that at the end of the term, you will get your money back. So preference shares are basically for people with low to medium risk appetite. Correct. So This was in short a small tutorial about the difference between equity shares and preference shares. If you have any doubt, you know what to do. Comment below the video, and as usual, I will be happy to help you. See you on Monday. Have a happy weekend. Bye.